What if a portion of your monthly bills were covered by money that came in whether you worked that month or not? Not from a second job, not from overtime, not from hustling harder, just from systems and assets you built that keep paying you on their own. That is what passive income actually is, and it is more achievable for ordinary people than most of the content you see online would have you believe. The term passive income has been so aggressively marketed over the last decade that it has become almost meaningless. It gets attached to get-rich-quick schemes, to overpriced courses, to unrealistic promises, and to strategies that are either completely passive and nearly worthless, or genuinely profitable but requiring enormous ongoing work. Today, we are cutting through all of that. This is the final video in this 10-part series, and I wanted to save this topic for last because building passive income is not where you start, it is where a solid financial foundation eventually leads you. Everything we have covered across these 10 videos builds toward this. The emergency fund, the debt elimination, the index fund investments, the automation, the compound growth. It all accumulates into something that one day starts paying you back. Today, I'm going to show you exactly how that happens, step by step, with real numbers and realistic expectations. Let's go. What passive income actually means and what it does not. Before we get into the steps, let's be clear about what passive income really is, because the honest definition is somewhat different from how it is usually marketed. True passive income is income generated by assets you own or systems you built that requires little to no ongoing active work to maintain. The key word is assets. Passive income is almost always the result of either money working for you through investments that pay dividends, interest, or grow in value, or systems you built working for you through intellectual property, digital products, or automated businesses that continue generating revenue after the initial work is done. What passive income is not is easy income. Almost every meaningful passive income stream requires either significant upfront capital, significant upfront time and effort, or both. A rental property generates passive rental income but requires capital to purchase, time to manage or money to pay a manager, and ongoing maintenance costs. A dividend portfolio generates passive dividend payments but requires years of consistent investing to build to a meaningful size. A digital product generates passive sales but requires real work to create, market, and occasionally update. The passive part comes after the active part. Understanding this prevents the most common disappointment people experience when they first try to build passive income, expecting it to be genuinely effortless from day one. Step 1. Strengthen your foundation before you build. The first step in building passive income is making sure the foundation we have spent 10 videos building is genuinely solid. And I want to be specific about what that means in this context. You need a fully funded emergency fund, at least 3 months of essential expenses in a high-yield savings account. You need your high-interest debt eliminated. You need a consistent monthly investing habit already in place. And you need a clear understanding of your monthly cash flow. Exactly what comes in, exactly what goes out, and exactly what is left to work with. The reason this matters specifically for passive income building is that most meaningful passive income streams require either patient capital accumulation over time or a meaningful upfront investment of money or effort. If your financial foundation is unstable, if you are still paying off high-interest debt, if you have no emergency cushion, if your monthly budget is running at zero, you do not have the resources or the stability to build passive income streams effectively. Every dollar you redirect toward a passive income project while carrying 20% interest debt is a dollar costing you 20% while hopefully earning you less. The foundation comes first. Always. Step 2. Start with dividend investing. The most accessible and most reliable form of passive income for most everyday investors is dividend income from a diversified stock portfolio. This is where the investing habits we have been building throughout this series directly translate into passive cash flow. Dividends are regular cash payments that certain companies and funds pay to their shareholders, typically quarterly, as a share of the company's profits. When you own shares in a dividend-paying company or fund, you receive these payments simply for owning the shares. You do not have to sell anything. You do not have to do anything. The money arrives in your account on a schedule. There are two main approaches to dividend investing. The first is through broad index funds that include dividend-paying companies. VOO and VTI, which we have discussed throughout this series, both pay dividends, currently around 1.3 to 1.5% per year. On a $100,000 portfolio, that is $1,300 to $1,500 per year in dividend income, paid quarterly with no additional action required beyond owning the fund. As your portfolio grows, so does the dividend income. The second approach is through dedicated dividend-focused funds. SCHD, the Schwab U.S. Dividend Equity ETF, is one of the most respected dividend funds available. It focuses specifically on high-quality U.S. companies with strong dividend histories and currently yields around 3.5% annually with a very low expense ratio of 0.06%. On a $100,000 portfolio, SCHD generates roughly $3,500 per year in dividend income. On a $300,000 portfolio, that is over $10,000 per year, more than $800 per month, paid simply for owning the fund. The key to making dividend investing work as a passive income stream is the same principle that drives all of long-term investing: time and consistency. Start by reinvesting all dividends automatically to accelerate the compounding of your portfolio. As the portfolio grows and your financial goals evolve, you can gradually switch from reinvesting dividends to receiving them as income. The transition from accumulation to income is one of the most satisfying financial milestones you will ever experience. Step 3. Explore high-yield savings and fixed income. While your investment portfolio is growing toward meaningful dividend income, your emergency fund and short-term savings are already generating passive income in the form of interest, and in the current environment, that interest is more meaningful than it has been in over a decade. High-yield savings accounts paying 4 to 5% annually, money market funds, short-term treasury bills, and certificates of deposit are all generating real passive income right now with essentially zero risks to your principal. A $20,000 emergency fund in a 4.5% high-yield savings account generates $900 per year in interest income, $75 per month for simply existing in the right account rather than a traditional bank account earning almost nothing. As you build a larger cash position over time, whether for a specific savings goal, a future property purchase, or simply as a part of a conservative allocation, this passive interest income from these instruments grows meaningfully. This is not where wealth is built over the long term, but it is genuine passive income that requires no active work and carries no meaningful risk, and it's available to anyone regardless of how early they are in their financial journey. We are halfway through, and I hope this is giving you a realistic and genuinely useful picture of how passive income actually gets built. If it is, please hit the like button and subscribe to this channel right now. This is the final video in our 10-part series, and subscribing means you'll be first in line for everything that comes next. It genuinely means a lot, and it helps this content reach more people who need it. All right, let's finish strong. Step 5. Consider real estate investment trusts. Real estate is one of the oldest and most reliable sources of passive income in human history. But the barrier to entry, the down payment, the mortgage, the property management, the maintenance costs, the illiquidity, puts direct property ownership out of reach for many investors, particularly those just starting to build wealth. Real estate investment trusts, or REITs, solve most of these problems.
A REIT is a company that owns and operates income-generating real estate, apartment buildings, office spaces, shopping centers, warehouses, hospitals, data centers, and is required by law to distribute at least 90% of its taxable income to shareholders as dividends. This means REITs tend to have significantly higher dividend yields than typical stock funds, often ranging from 3% to 6% or more annually. The most accessible way to invest in REITs as a beginner is through a REIT index fund rather than individual REITs. VNQ, the Vanguard Real Estate ETF, tracks a broad index of U.S. REITs and currently yields around 4% annually with an expense ratio of 0.12%. By adding a REIT fund to your portfolio, you gain exposure to real estate income without needing a down payment, without dealing with tenants, and without the illiquidity of owning physical property. A sensible approach for most investors is to keep REITs as a supplementary portion of a broader portfolio, perhaps 10 to 15% of total holdings, rather than a dominant position. They add income and diversification, they behave somewhat differently from regular stocks, which can smooth overall portfolio volatility, and they give you real estate exposure that would otherwise require significantly more capital and complexity to achieve directly. Step 5. Build a digital income stream. Beyond investment-based passive income, there is a category of income streams that can be built with time and skill rather than capital. These require meaningful upfront work but can generate ongoing income with relatively little maintenance once established. I want to cover these honestly, including what they actually require, rather than giving you the sanitized version that most passive income content presents. Digital products are perhaps the most accessible of these. An ebook, an online course, a set of templates, a piece of software, a photography collection licensed for commercial use. These are things you create once and can sell repeatedly with no additional production cost per sale. The income from digital products is genuinely passive once the product is built and a distribution system is in place, but the work of building a quality product, creating an audience, setting up marketing systems, and maintaining the technical infrastructure is substantial and ongoing. Nobody builds a successful digital product business in a weekend. Content creation, YouTube channels, podcasts, blogs, newsletters can generate advertising revenue, sponsorship income, and affiliate commissions that eventually become largely passive as an audience grows and back catalog content continues to attract new viewers and readers. The income from a well-established YouTube video continues to arrive for years after the video was published. But building an audience large enough to generate meaningful income through content requires consistent output over a long period of time, typically measured in years rather than months. Affiliate marketing, earning commissions by recommending products and services to an existing audience, is another digital income stream that can become largely passive once the audience and content are in place. The key word in that sentence is existing audience. Without an audience, affiliate marketing generates almost no income, regardless of how good the products are. Building the audience is the active work. The affiliate income is what follows. The honest framework for evaluating any digital passive income stream is this: how much total time and effort does building it require, and what is the realistic income potential relative to that investment? The answer for most of these streams is that the upfront work is significant and the payoff, while real, comes slowly and unpredictably. They work best as long-term projects built alongside a stable financial foundation, not as quick fixes or primary income replacement strategies.
Step 6. Think about rental income realistically. Rental income from physical property is one of the most powerful passive income streams available, but it is also one of the most misunderstood in terms of what it actually requires to work well. The income potential is real and significant. A well-chosen rental property in a strong market can generate monthly cash flow after mortgage, taxes, insurance, and maintenance that meaningfully supplements your other income. Over time, as the mortgage is paid down and the property appreciates in value, the equity and cash flow both grow. Many people have built genuine financial freedom through rental property investing over a career. But the passive label requires serious qualification. Managing a rental property, finding tenants, handling maintenance requests, dealing with vacancies, navigating legal requirements, managing repairs is active work, particularly if you manage it yourself. Hiring a property management company to handle operations typically costs 8 to 12% of monthly rental income, which meaningfully reduces your net cash flow, but makes the income genuinely more passive. The upfront capital requirements, a down payment typically of 15 to 25% for an investment property, plus closing costs and initial repairs, are also substantial barriers that most people cannot clear until they have built significant savings first. If rental property investing appeals to you, the right time to explore it seriously is after your personal financial foundation is solid, after you have accumulated meaningful investment assets, and after you have genuinely educated yourself on real estate analysis, local market conditions, landlord-tenant law, and property management. It is a powerful vehicle, but one that rewards preparation and punishes naivety. The resources in the description below include some excellent starting points for anyone seriously considering this path. Step 7. The 4% rule and what financial freedom actually looks like in practice. Everything we have covered in this video and across this entire series builds toward a concept that I want to close with because I think it gives the clearest possible picture of what financial freedom through passive income actually looks like in practice. The 4% rule is a guideline developed from decades of financial research, most famously the Trinity study from 1998, that suggests a retirement portfolio can sustain a 4% annual withdrawal rate indefinitely without running out of money, assuming a diversified stock and bond allocation and historical average market returns. In plain terms, it means that if you have 25 times your annual expenses invested in a diversified portfolio, you can live off that portfolio essentially forever. Let's put real numbers on that. If your essential annual expenses are $40,000, you need $1 million to generate that income at a 4% withdrawal rate. If your expenses are $30,000, you need $750,000. If your expenses are $60,000, you need $1.5 million. These are not fantasy numbers for high earners only. They are achievable targets for someone with an average income who starts early, invests consistently, and lets compound growth work for 20 to 30 years. The numbers we ran through in Video 7 on compound interest show exactly how this is achievable. Someone who invests $500 a month from age 25 to 65 at a 10% average return accumulates roughly $3.2 million. At a 4% withdrawal rate, that portfolio generates $128,000 per year in passive income, more than $10,000 per month, without ever touching the principal. That is what financial freedom built through consistent investing over a long period of time actually looks like. Not a lottery win, not a viral business, just time, consistency, and the willingness to start. Putting it all together, your passive income roadmap. Let me give you a clear, sequential roadmap for building meaningful passive income over time, one that is realistic, achievable, and grounded in everything we have covered across this entire series. In the first phase, which covers roughly your first 1 to 3 years of serious financial focus, the goal is foundation and habit. Build your emergency fund, eliminate high-interest debt, open a Roth IRA, start automatic monthly contributions into a low-cost index fund like VOO or VTI. Set DRIP, dividend reinvestment, to on, so all dividends automatically buy more shares. At this stage, your passive income is small, perhaps a few dollars per month in dividends, but the habit and the compounding engine are running. In the second phase, which covers roughly years 3 through 10, the goal is growth and acceleration. Increase your contribution rate whenever your income grows. Max out your Roth IRA contribution limit each year if possible, $7,000 in 2024. Consider adding an international fund like VXUS for global diversification. Begin exploring a REIT fund like VNQ for real estate exposure and additional dividend income.
Your dividend payments are now growing noticeably, and you are beginning to feel the momentum of compounding in a tangible way. In the third phase, which covers years 10 and beyond, the goal is multiplication and freedom. Your investment portfolio is now large enough that the market's annual returns and dividend payments are contributing more to your wealth than your own contributions. This is the inflection point where compound growth truly takes over. You can begin evaluating additional passive income streams, a digital product, a rental property, a more focused dividend portfolio, from a position of financial stability and genuine choice rather than financial pressure. And the 4% rule target that once seemed impossibly distant is now clearly visible on the horizon. This is the 10th and final video in this series, and I want to take a moment to bring everything full circle before we close. We started 10 videos ago with $100 and a question about where to begin. We covered the foundation, emergency funds, eliminating debt, opening the right accounts. We went deep on index funds, compound interest, the psychology of investing, the mistakes most beginners make, and the principles that actually separate people who build wealth from people who do not. And today, we closed with the end goal: genuine passive income, financial freedom, and a clear picture of what it actually takes to get there. None of this is complicated. None of it requires special access, a high income, or a fortunate start in life. It requires a decision. The decision to learn how money works, to build the right habits, to start before you feel ready, and to stay consistent long enough for time and compounding to do what they inevitably do. Every book, tool, and resource I have referenced across this entire series is linked in the description below. If you have watched all 10 of these videos, you now have a more complete and practical financial education than the vast majority of people ever receive. What you do with it is entirely up to you, but I genuinely hope that something across this series has shifted something for you. An idea, a habit, a decision that makes your financial future meaningfully better than it would have been otherwise. Please drop a comment below and tell me which video in this series was most useful to you, or what topic you would like me to cover next. I read every single comment, and your feedback genuinely shapes what I make next. And if you have not already subscribed to this channel, please do that now. This series is complete, but there is so much more to come, and I would love to have you along for it. Building a better financial life changes more than your bank account. It changes your stress, your choices, your opportunities, and your future. And if you are ready to keep learning and keep building, go ahead and watch the next video, because this is only the beginning.